Welcome to this video on option spreads. What is an option spread? An option spread is a position where options offset each other in some way. The most common spreads have two contracts, with one being long and one being short. Depending on which contract is bought and which is sold, the spread will either cost money to open or pay you to open. If you pay to open it, it is referred to as a debit spread. If you are paid to open it, it is referred to as a credit spread. They are also called either bull or bear spreads, depending on whether they make money when the price goes up, a bull spread, or down, a bear spread. There are three types of spreads that work with the expiration and strike price. We have the vertical spread, where we have the same expiration but the strikes are different. The calendar spread, which uses the same strike but different expirations. And a diagonal spread, where both the expiration and the strike are different. Let's look at these in more detail. Vertical call spread example. If we BTO, which is buy to open, a January $100 call, and STO, which is sell to open, a January $100 call, this would be a debit spread, and this spread profits most when the price ends up above $110. That makes it a bull call spread. The most you can lose is the amount paid to open the spread. This happens when the price ends up below $100. The most you can gain is the strike difference minus the amount paid, in this case $10 minus whatever it cost to open. If it cost $5 to open, then the max gain would be $5, which would double your money. The less you pay, the higher the max return you can get. You can calculate the return of a multi-leg strategy by looking at the return of each leg and adding them together. Here we have a long call where the value increases at the strike price, and a short call where the value decreases at its strike price. When we add them together, we get the return of the spread. Another example, sell to open a January $100 call and buy to open a January $110 call. This would be a credit spread. This spread profits most when the price ends up below $100, and that makes it a bear call spread. In this case, the most you can lose is the difference between the strike spread and the premium you receive to open the position. It's the opposite of the debit spread. The most you can gain is the net premium received to open the position. When the price is below $100, both calls will expire worthless and you keep the premium received. Above that, you'll have to pay something to close the position. This is basically a short call with some loss protection built in. Let's look at vertical put spreads. Here we have some examples. If we buy to open a January $110 put and sell to open a January $100 put, this would be a debit spread. And this spread profits most when the price ends up below $100, and that makes it a bear put spread. The most you can lose is the amount paid to open the spread. This happens when the price ends up above $110, and the most you can gain is the strike difference minus the amount paid. In this case, $10 minus the open cost. Again, if it cost $5 to open, the max gain would be $5, and you would double your money. Another one would be to sell to open a January $110 put and buy to open a January $100 put. This would be a credit spread. And this spread profits most when the price ends up above $110, and that makes it a bull put spread. In this case, the most you can lose is the difference between the strike spread and the premium you receive to open the position, the opposite of the debit spread. The most you can gain is the net premium received to open the position. When the price is below $100, both calls will be in the money. You've seen from the graphs that most of the results are either max profit or max loss. There's only a small price range between the two strikes that gives a result that is in between. Because of this, vertical spreads are often viewed as all or nothing, meaning you make the max or you lose the max. Vertical spread timing. The vertical spread makes most when held to expiration. Because of the time value differences, a vertical spread will not reach full profit until close to expiration. Even when both legs of a call spread are in the money, the sold leg will be closer to the share price than the long leg, so we'll have a higher time value meaning closing the position will eat into your profit. The further away from expiration, the bigger this difference will be. For debit call spread, the price will be above the higher strike, which is a sold strike, and for a credit call spread, the price will be below the lower strike, which is also the sold strike. This graph shows the net time value left in a debit call spread with various times left to expiration. To exit the position early, we'll have to pay that time value. That is why it is better to wait until expiration. This doesn't mean you can't make any money closing early, just not the maximum. Next, we have calendar spreads. A calendar call spread is designed to be closed before expiration. That is, when it is still a spread and nothing has expired. If one of the legs were to expire, then the position would just be a long or short call or put. In this case, a call. Because you are buying and selling the same strike, this strategy is not based on how the underlying price will move, but rather on how the premiums will change, specifically the premium of the longer expiration. If we assume that the premium of the shorter expiration is almost zero when we close it, money is made or lost based on how the premium of the longer expiration changes. Let's look at an example. If we buy to open a March $135 call and sell to open a February $135 call, so it'll be a debit spread, before the February expiration, but close to it, you sell to close the March $135 call and buy to close the February $135 call. Basically, the opposite of what you did to open it. Whatever the share price, the intrinsic values will cancel each other out. So basically, you're making money if by February, the March call is worth more than the initial debit to open the position, because that's really what you're selling. If we assume that M is the premium of the March call and F is the premium of the February call when opened, and also assume M prime is the premium of the March call and F prime is the premium of the February call when closed, then our result will be the difference between the prime premiums and the non-prime premiums, and all intrinsic values will cancel out. Furthermore, if we assume that the time value of the F prime is zero because it's going to expire worthless, the result is the premium we get from the M prime minus the difference between the M and the F that we paid to open it. So the value of the M prime, which is the March expiration in February, must be more than the initial debit paid to make a profit. This requires the volatility to increase, but the share price to basically remain the same. And this is an advanced position, and I don't recommend starting with this kind of spread. Diagonal call spreads. A diagonal call has two legs with different expirations and strikes. A long call with a far-out expiration and a lower strike. A short call with a nearer expiration and a higher strike. A diagonal call spread will always be a debit spread. This strategy is designed to repeat the short call multiple times. And a perfectly executed diagonal call will end up as a vertical call spread. What is a perfectly executed diagonal call? When each of the short calls expires worthless and the stock price has appreciated such that the long call can be sold for a profit. It is also fine for some of the short calls to be rolled up and out for a credit. Up and out means to a higher strike, and out means to a further expiration. This will be possible when the stock price is above the short strike, but not by too much. Sometimes this might mean rolling out further than you usually do, so a further expiration. In certain cases, it can also be okay to roll up and out for a debit. How do you choose the strikes and expirations? The long call expiration should be far out. The long call strike should minimize the time value bought. So look at the furthest expirations available, and this also determines how long the position can keep going. And choose a strike where you figure out what percentage of time value you want to pay in the premium. The short call strike should allow for a profit in case the spread needs to be closed right away. If the stock really shoots up, for example, and it's not feasible to roll it out or sell a new call. The differences in strikes should be greater than the cost to open the position. You can also use this strategy with shorter expiration and plan for less calls to be sold. But keep in mind that the shorter the expiration of the long call, the less time the price has to go in the direction that you need. You basically have to, as just like when a bought call, you need the price to go up to make back the time value that you paid to open it. Let's look at some diagonal call spread examples. If we buy to open a January 2027 $55 call at $47, and we sell to open a March 2025 $105 call for a $3 premium, this will be our debit spread, our cost is now $44 per share, and our spread is $50, so our potential profit of $6 per share if we were to execute or exercise and be assigned on both of the options. When March comes around, let's say our $105 call expires. And then we sell to open a June 2025 $110 call, again for $3. Our cost has now decreased to $41 per share, and our spread has increased to $55. Potential profit of $14 per share, 5 from the larger spread and 3 more from the premium. If again our June 2025 $110 call expires, we would sell to open a September 2025 $115 call for $3 maybe. Our cost has now decreased to $38 per share, and our spread is $60, a potential profit of $22. $5 from the larger spread and $3 from the premium. If that September call expires, we could then sell to open a 2025 $115 call for $3. Our cost is now $35 per share. Our spread is still $60, giving us a potential profit of $25, 3 more dollars from the new premium received. This shows 4 short calls. You can do as many as you can fit into the longer expiration. This example would have room for maybe 4 more, with the last one expiring on the same expiration as the long call, to be January 2027. Let's look at a real example. This one's based on eBay and happened a few years ago. If we buy to open January 2021 $18 call and paid $16.75 for it, at the same time sold to open in April 2019 $35 call for $1.23, the stock price is about $32.90. We've paid $15.52 to open the position. That's our cost. And our spread is the difference between 35 and 18, which is $17. So we have a potential profit of $1.48 per share. In this case, we bought to close the April 2019 for $2.88, and we sold to open an October 2019 $37 call for $3.33. The price has risen to $37.81. Our cost is now $15.07 per share, and the spread is now $19, giving a potential profit of $3.93 per share. Around October, we bought to close the October $37 call for $2, and we sold to open a January 2020 $39 call for $2.06. The share price closed around $38.92. Our cost is now $15.01 per share, and the spread is $21. potential profit of about $5.99 per share. The January 2020 call expires worthless, and we sell to open a March 2020 $37 call because the price is now dropped to 35. So we're actually sold a lower call to get a better premium than the $39 call. The cost is now $14.08 per share. Our spread is $19, giving us a potential profit of $4.92 per share. Our March 2020 call expires worthless because the share price has dropped quite a bit, down to $26.34. Cost is still $14.08, but the price has fallen such that I don't find a good call to write, so I kind of forget about this transaction. The price recovers to $55.71, and I'm able to sell the long call for a profit. So I sell my January 21 $18 call for $37.38. The net profit is $23.30 per share, which is a 150% return on the $15.52 initial investment. A simple long call would have made $20.63, which is a 123% return on the $16.75 initial investment it would have been. This diagonal was not very well executed because I kind of forgot about it, but you can see the impact you can have versus a simple long call. Thank you for listening. Please let me know what you think and if you're interested in more complicated spreads.